If you're over 45, there's a fear haunting you. The feeling that the retirement train has already left without you. Traditional advice says time in the market beats everything. But what if you're starting late? From a behavioral finance perspective, these people fall into a psychological trap. Intense regret bias and late-stage risk aversion. But here's the shocking mathematical truth that shatters this psychological illusion completely. Investing $27,000 annually at a historical 10% return brings you to approximately $430,000 in just 10 years. This becomes the financial backbone, one solid pillar supporting everything that comes next. Retiring at 55 with a portfolio between $1.2 and $1.5 million isn't fantasy. It's pure mathematics and behavior. The secret? A strategic system called the Zero to Hero portfolio, built on 5 powerful pillars. Ordinary people followed this exact system. Teachers, nurses, everyday professionals like you. They started late, felt the same fear you feel right now. But the numbers didn't lie to them. The psychological shift happens when you realize your 40s aren't a dead end. They're a launching pad. This isn't about catching up. It's about strategic acceleration from exactly where you stand today. The mathematics work for anyone willing to start today, regardless of the calendar year they were born. Most people think saving 35 to 45% of their income requires living like a monk, depriving themselves of every pleasure. But the real secret isn't deprivation. It's the psychology of income expansion. Train your mind to channel every side income stream directly into your investment portfolio, not your spending account. This removes the psychological pressure of daily deprivation because your base income remains untouched. Pillar 2, the sequence strategy. Most investors jump straight into index funds without optimizing the order of their accounts. Broad market index funds like VTI or FZROX are powerful, but where you place your money matters more than what you buy. Tax-protected accounts like 401k, IRA, and HSA are your secret weapons against the invisible tax bleed. By strategically sequencing your contributions into tax-advantaged accounts first, you save over $100,000 on the same invested capital. No extra effort, no additional risk, just intelligent sequencing that shields your wealth from erosion. The hidden tax drain costs the average investor more than market crashes ever will. Master these 2 pillars. Expand your offense budget without deprivation, and optimize your account sequence to eliminate tax bleed. These are the foundations of accelerated wealth building. Most late investors chase quick lottery wins, but the real strategy lies in asymmetric assets, low risk, explosive upside. Real estate and alternative assets accelerate growth without exposing your capital to extinction-level risk. This is Pillar 3, the asymmetric asset strategy that separates disciplined builders from desperate gamblers. Now, Pillar 4, the protection layer. High-yield savings accounts earning over 4.5%. These accounts act as financial shock absorbers, cushioning your portfolio against sudden market turbulence. But this layer is not just financial. It is a psychological shield that guards you from panic selling. When markets crash and fear spreads, this shield prevents the late investor from making catastrophic emotional decisions. It is the difference between holding steady through volatility and destroying your portfolio in a moment of terror. This protection layer is your fortress, a reserve that lets you sleep at night even when headlines scream disaster. Together, asymmetric assets and the psychological shield form a dual-engine system for the late starter. One accelerates growth with controlled risk, the other protects your mind from sabotaging your own success. This is how late investors build wealth without gambling their future. The 5th pillar of behavioral finance is accountability and community. One decision in behavior is worth more than any stock pick. Surrounding yourself with a community that shares your financial goals creates discipline and commitment that no individual willpower can match. Now let's examine the psychology of real numbers. We'll review 3 inspiring case studies of people who started from nearly zero. Case 1. An Ohio teacher started at age 43 with only $68,000 in savings. By age 53, he retired with a portfolio worth $2.4 million. Case 2. A Texas nurse began at age 48 with just $47,000 saved. By age 58, she retired with a portfolio of $1.6 million, plus a property worth $230,000. Case 3. A Michigan manager started at age 42 with only $31,000 in savings. By age 52, he retired with a portfolio that reached $1.8 million. The psychological analysis reveals that these numbers shatter the helplessness bias in the viewer's mind. They prove, through the Trinity study and the 4% rule, that the behavioral system is the deciding factor. Discipline and community are more powerful than any individual stock choice. Your current age is not an obstacle. It's your competitive advantage. At 45, you possess wisdom and life experience that 20-year-olds lack entirely. You know how to manage emotions during financial crises, something the young cannot do. We conclude by merging the 5 pillars into a step-by-step guide you can start applying today. Changing your financial trajectory at 45 doesn't require miracles. It requires strict capital discipline and applying financial mathematics with cold precision. The 5 pillars form your complete blueprint: offense budget, sequence optimization, asymmetric assets, psychological shield, and accountability. Start with income expansion through offense budget, your first weapon against time. Then apply sequence optimization, timing your moves with mathematical precision. Build asymmetric assets, where small investments yield massive returns over time. Forge your psychological shield against market panic and emotional decisions. Implement ruthless accountability systems. Measure everything, adjust constantly. This isn't theory. This is the contrarian blueprint that reshapes financial destinies. Your 45-year-old brain can execute what 20-year-olds cannot even comprehend. The 10-year trajectory starts today, not when conditions are perfect, but now. Age 45 to 55, this is your decade of aggressive capital accumulation. Discipline, mathematics, and cold-blooded execution, these are your only true allies. Share your 10-year financial plan in the comments. What's your first move starting today? Follow us for more.